Okay, as I mentioned, you guys, this is being recorded. And one thing I say at the beginning of all these, and I think it's really important, watch it again, especially if you're not, how do I say this? Especially if you're new to trading options or if you're new to like how to do this, because I'm going to go through a lot of things that might fly by you because you're thinking of different questions and stuff like that. These are things that you're not going to be able to find anywhere else on the internet. I mean, I talk about this all the time. Yeah, you can figure out how to do a short strangle on the internet by selling it out at money call and out at money put, but they're not going to give you statisticals, or that's not the right word. I'm kind of got marbles in my mouth today, I guess. There's not a lot of statistics out there for people to pick the right strikes and things of that nature. And then, of course, what do you do when that strangle goes against you? And I'm going to go through the steps, the ways to be mechanical to increase your probabilities. And I've actually done some little math just based on my own research here, gone through, like, I have probably 4 or 5 spiral notebooks here that I basically keep track of all my trades, and I write down why I got in them, where my exit price is, and when I get out of those trades. So, and I would think that you guys should do that as well, because what it does is it keeps you on task, especially when you're putting on a strategy, to say when you're going to exit that strategy and stick to it. You're more likely to stick to it if it's written down. And you know, if the strategy goes against you, you can go back, look at your notes and say, this is why I got into it. So, you know, despite the fact that it's going against me, the probabilities were this, that, and the other thing, and these are my next steps that I need to take. So that's what I try and teach you guys, is stick with the probabilities, and that will keep you on task, and hopefully keep you more profitable anyway. So without further ado, let's just get on with this. My name is Wilkinson. Some of you guys may recognize me as the Wolfman from CNBC, Fox Business, or the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in all market conditions. I actually started out trading in college with some money I'd earned. Was trying to get a psychology degree, switched it over to finance, and after graduating college with a finance degree, moved up to Chicago and started trading basically shortly thereafter. Got to go over this disclaimer. Any opinions, news, research, or analysis, or other information contained here or information provided by ProTrader Strategies, associated companies, or employees is provided as general commentary. It does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. Basically what this is all saying, you guys, is I can't tell you, hey, go out and put on this strategy in XYZ, because it is a home run type investment. The reason why is I don't know your risk parameters. I don't know what's in your portfolio, so it very well could be counterintuitive to what you are already doing. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. Yeah, Trevor, I hope the rest of this webinar goes a little bit better than that beginning of this introduction. Sounds like I have booze in my coffee. Nope, no booze today. Anyway, you can also follow me on Twitter at Wolfman's blog for investment stuff, especially during earnings seasons. We're getting ready to get into earnings season, and I will be tweeting out at the end of the day what my trades are, just to keep everybody on the same page as me, because in the daily market commentaries, I always talk about every trade that I'm doing, when and where I put them on, how I'm managing them. One of the case studies that we're going to be talking about today, I've been constantly talking on these daily market commentaries about that specific trade. So I do that earnings trades because I do those at the end of the day. I do the market commentaries in the morning, so I just want everybody to have that opportunity to see what I'm doing. And you can follow ProTrader Strategies at ProTrader Strat. All right. So this is going to be defending the short strangle. Now, when I talk about with the long strangle, and anytime you're paying a debit for something, it's very difficult to manage it. It's kind of like you put it on and you let it go. But the beauty in credit strategies is that there is a lot of wiggle room. There's a lot of ways that we can get in there and manage these, because we can collect different credits in different ways. And when you can collect different credits, you can increase your probabilities of success, because you increase your break evens, and you get a bigger credit, which may decay quicker once that volatility comes out of those. But I want to go over a couple of things that, you know, if you don't know much about the short strangle, this is a little bit of a review from the webinar, so you can check that out where I go into all the details. I'm not going to go over the entire short strangle today. But remember, from those of you, I know a lot of you guys are repeat or have been in these webinars quite often, so you saw this webinar. But basically, my rules for the short strangle, being market neutral, is selling an out of the money call at around a 16 delta, and then selling the out of money put around a 16 delta without a parenthesis at the end. All right, so, and the reason why is because we're trying to sell this one standard deviation strike price. 16 delta lines up with the one standard deviation, if you remember. So our probabilities are really good that it's going to land in here. But remember, when we talked about that probability of being touched is 2 times what the delta is. And so if this is around a 16 delta, we have about a 32% chance of it coming up and testing our one standard deviation strike. So I'll go over some of the rules here in a minute, but when and where we start making this move. Is everybody else getting some sound? Ramesh is saying that he isn't getting sound. All right. Anyway, hopefully you can see that. All right, audio is great, Roger. Okay, I just sending a thing. All right. So, and our max profit is always the credit we received in these short strategies. The max loss with this particular one is unlimited to the upside, and basically going to feel unlimited to the downside. It's when the underlying goes to 0. I've talked about we're not going to ride it into the dirt like that, and the rules when and where to get out. Now, the one thing I want you guys to remember is the break even is when the underlying price is equal to that short call strike plus the premium received, because that premium, being a collection, increases our break even. You know, if you're paying a debit, it kind of lowers your break even. So when we're getting a credit, the short call strike plus that premium of the short call and put together, the total premium, is our break even to the upside. And to the downside, the underlying price is equal to the short put minus the premium, because remember, it's a credit, so it can go further below that short put. Now, this is important because that's when we're going to be talking about when we start going in and defending the short strangle. Okay, so remember your break evens. Those are the ones, those are the things you want to write down when you're setting up this strategy. Put down your break evens or where you are going to defend that, because it's pretty important. Now, it's not a hard line rule that you have to go exactly when the break even is. As a matter of fact, in the case study, I went a little bit early, but that was because it was a pretty aggressive move rather quickly, and I'll go into a little bit more detail about that here in a minute. So steps defending the short strangle. Basically, we are going to be looking at rolling if our break even is tested. That's what I was just talking about, the short call minus, or sorry, short call plus the credit received, the total credit received, or the put minus the total credit received. And the reason why you could add in both credits to figure out your break even is because it can't go in both directions at the same time. Okay, it can only go in one direction at any given time. So when the break even's tested, that's when we're going to roll. And we're going to roll the untested side up to about the 30-ish delta. Now, this is where I was talking about where I've kind of gone back through all my notebooks, did some back of the napkin math, if you will, and figured out some of the probabilities. Now, if you guys remember when I said we had do it in the 16 delta, the probability of touch is 2 times that delta, which would be expected to be around 32% of the time. Well, believe it or not, some of the actual on the upside was the probability of being in the money was around 9%, and the probability of touch was around 16 on these strangles that I've been doing. But we haven't had massive moves up lately, you guys, so that could be a little bit skewed. It's been basically a slow trudge to the upside, right? We haven't had any massive moves, so keep that in mind as well. And then to the downside, the 16 delta was basically only coming in the money 6% of the time and had a probability of touch of about 17, and that was for the downside. So those numbers are a little bit different based on the math, and this is also based on the trades that I have done too. So it doesn't mean that the trades that I haven't done haven't had higher probabilities and would skew my numbers. These are just the trades that I've done. So you do not roll. Trevor's asking, do you roll the tested side? No, we don't ever roll the tested side unless we're rolling out in time to get a larger credit, which is on to the next one, is we roll out to extend duration. We're going to be able to collect even more of a credit when we do that, so it'll increase our break evens even more when we roll out in time only for a credit. If you aren't getting a credit, it's not worth rolling it out and taking on more risk. That's when you pull the plug on this thing, or the ripcord, as I like to say, and pull out the safety chute, get out of that thing, get out of that free fall or whatever's happening. We're going to just walk away from it. If you are still sure about where, or believe, I can't say sure necessarily, but if you still believe that the market is going to go inside of your short call and your short put, then roll it out. If you think there's just an anomaly where it's a timing thing, it came in, roll it out in time, and you can stay with it, collect more of a credit, and keep the dream alive in a sense. All right, so one other thing with that probability of touch and stuff like that is after the rally happens, okay? It's better, I found that it was better to roll the puts than it was to roll the calls. It's, for instance, if the market came down and tested my puts, okay, or my puts break even, had a better success rate when I didn't roll those calls back down, because the market had a tendency to pop back up more, and that also has to do with the environment we've been in. It's been a very bull market for almost 10 years, right? For the most part. So these long duration bull markets, that's what we would expect. If we were in a bear market, it's probably going to change those probabilities. So, but after the rally, the probability of touch on those puts after the roll was only, we're rolling to the 30 delta, so that we would expect that our probability of touch on those puts after that rally would be about 60%, that the market would come back down, right? Because that's that back of the Mac, that floor trader hack is 2 times the delta. So if we roll up to a 30 delta with our puts, we would expect the probability of touch on those puts to now be 60. Well, the actual numbers were 38 probability of touch, and the actual percent of expiration below we would expect to be 30, because it's the 30 delta, and it was only about 15. So that was just some little research that I've done. I would stick to the long tried and true floor trader hack, but just to give you a little bit of solace and some numbers backing what has happened with me, and basically the past, I went back about a year and a half on these numbers, and those were the numbers that I was coming up with. So, just keep that in mind. So the probabilities are slightly less, for all intents and purposes, than the floor trader hack, but go with the floor trader hack numbers, because I don't want you to hold a ton of weight in just the trades that I have done, okay? When you roll, do you roll up to the 16-ish strike? No, we're going to be rolling when we're tested on that break even. We're going to roll. So here, I'm going to throw a couple examples, because we'll go over this a little bit more. Now, this is a really old example of ADM, because you know, believe it or not, I don't take screenshots of every single trade I do at any given time, but this was one of those trades that I did happen to take a screenshot of it. I don't always think about it, but this is a iron condor, and it's basically very similar to the Strangle, right? Except it's defying risk. But the rule of rolling the iron condor are going to be basically the same as the short Strangle, because when the break even is tested here, in this case, the break even on this ADM iron condor was tested. These puts went into the money, and, or sorry, these calls went into the money. So I rolled the entire put spread up, you know, the short put to the 30-ish delta, which this one happened to be the 28. I didn't want to go too far, because you kind of want to leave yourself even a little bit more wiggle room, because now if your next break even goes, then you just turn it into a iron butterfly, or in the case of what we're talking about with this short Strangle, into a straddle, where both the calls and the puts are the same. It gives you a little bit more wiggle room in order to collect more credit within that same options cycle. Okay, so in this case, I was looking to defend this by rolling the puts up to the 34.5 strike, which was right around there. It looks like I was able to collect around 20-some cents, which increases my break even to this upside and downside from here. It's not going to be your break even down here anymore. Your break even is going to be in here, but rolling that in time. So that is actually the final result, is how that was set up. It looks like I actually went down to the 35 probably to collect a little bit better than 20 cents. That makes more sense that I'd roll it there to get around 30 cents for that roll on a spread. There's nuances there. Anytime I'm doing a spread, I want to collect at least a third width of the strike. I don't like to collect less than that. It doesn't make it worth it. But rolling that to collect another 30 cents for an iron condor, I probably would have been looking to collect around 30 to 40 cents on it. So now I've collected a total of about 50 cents on that. So I've lowered my risk, especially on a spread like that. And then this is the case study that I want to talk about here. So I originally set this strategy up just recently, as you can tell, and I did it as a Strangle. Volatility was pretty good. You can see there's a volatility coming off here, but that has to do with what happened later on. I just took a screenshot of the days coming up, but this is the day I put it on. I was like, okay, it looks like it's gonna, we got volatility at pretty much high. Didn't see any news with Boeing. I talked about this in the daily market commentaries. Boeing has a tendency to really flatline. You know, I talk about that rubber band winding up with most stocks. Well, Boeing doesn't really do that. It's kind of one of those boring stocks. So when it gets high volatility, it's a good time to do this. Same thing here, you know, it just has a tendency to flatline. Well, clearly, because I'm talking about it, that didn't work out. But so I sold the 255 calls and the 215 puts, which is a nice fat Strangle. I mean, those probability 16 delta, you know, volatility comes out, I'm golden within a couple of days, and I collected $2 credit. So my break even to the upside would be right around 257, and my break even to the downside was right around 212.95, right? So I knew that going into it. Well, lo and behold, this happens. And as soon as it started breaking out, I was like, this is not looking good. I got a couple of days in a row. I thought maybe I waited right here. It kind of started gapping up a little bit. I was like, maybe this is just a little overdone, testing highs. And then we did it again the next day, and I was like, okay, all these complacent people are going to be freaking out, thinking, you know, the people that got in here thinking, okay, this gap is going to be covered, which a lot of traders do. They'll start selling this. They see this kind of top, okay, the market wants to go and cover those gaps. You know, that's just a technical analysis thing. Well, once it starts doing this, people are like running, you know, out the door. So I actually went in a little earlier than it hitting my break even. As you can tell, my break even to the upside, if we remember in the original trade, my break even is 257. Well, I didn't wait for that. Just, I had a gut feeling. I was like, this isn't looking good. I want to roll this sooner than later because I want to still have a strangle on that's pretty wide. And if I waited till it went to my break even, I was probably going right straight to a straddle, which I didn't necessarily want to do in this instant. But I wanted to be able to collect a nice credit before, you know, it hit the fan. So I rolled a little more aggressively than I normally do. So I rolled the 215 puts, which, you know, for 41 cents left in that, you know, I collected over 50 cents already that I'm getting to keep. And I rolled up to the 245 puts, collected another total of $2.57. So all in all, when I originally did this strategy, just to go back, I collected $2 for that original strangle, and then I collected another $2.50, which makes my total credit $4.61, right? Is that making sense with everybody? So now I've collected $2.61. So now my break even on this thing is at $259.61 to the upside, and my break even to the downside, we're subtracting that $4.61, so it's $240.39. I'm doing that in my head. I hope I did that right. So, you know, I'm increasing the break even from way down here when it was at 215, but, you know, I also hold solace in knowing that the puts are probably going to get tested, but it's less likely than after finding out my back of the napkin math. But anyway, so I increased my break even to the upside because that's really what I'm concerned about right now with this market move. And we can look at what happened with that trade so far. I still have it on, as a matter of fact, but we're back inside of the zone, those 255s. But if you look at it, those dates where 9/18 was the day I rolled those, which was right here. Well, you can see the next day it actually looked pretty good. Like, oh, you know, if you're a technical analysis, okay, that looks like it's going to be good. Well, never got confirmed and went up, and it went up to test my break even, which was 259.61. Remember, so I was very close to rolling those puts up to make a straddle. If it was going to test those break evens, I was going to do that immediately. Came up short, and then we got this sell off, and now I've gotten a couple of confirmations. It looks like it wants to trend back down a little bit. So, you know, obviously if it comes back down to 250, which it's been very close, you know, I'll be very happy. But just having said that, you know, and my 245s are still down here. So I got a lot of wiggle room with this, you know, with only a couple, you know, 21 days left to go. I'm probably looking to get back to break even on this because it's such a tight strangle. But, you know, stay tuned on those daily market commentaries because I'll be talking about this trade specifically. You know, I say this all the time in those daily market commentaries. It's like, you know, the winners come and go. I went through my book and checked on the last like 10 or so strangles that I've done, and none of those I had to defend. So, you know, I couldn't find any other examples in this one that I'm currently in. So I haven't gotten out of this yet. Still on. Last I checked, I think I collected $4.61. I think it was trading right around $5-ish. I mean, we can go and look at it. It's 5 something. We can go and look at it right here. So go into the Boeing trade. So we can look at it, $3 and let's call it 60 cents, right? 360, 365 and $1. So 475 for it's better than what I thought. So, you know, I collected 461. It's pretty close to break even now. So, and that's what we're trying to do here. And that's what I want to emphasize to you guys is that stay mechanical with this trade. You know, you don't have to, you know, I went into this trade thinking that I had a really good trade on. I was going to make about $1 on this trade. Well, it came and bit me. All right, and you know, I might have done better had I not rolled this up, but you don't know that. Hindsight's 20/20. It's just like these guys out there that will show you, hey, go put this strategy on. You know, look, had you done this, it would have been a winner. Well, I don't play that game, you guys. I play the real trade and talk to you guys about these real trades in real time. So yeah, hindsight being 20/20, maybe I'd do better off had I left these down here. But look, those 215 calls at this point aren't helping me at all. And if you look at, am I still on that, right? So look, these puts are trading right around, let's just call it 225, just for sake of argument, right? 225 are those puts. I basically was able to collect, you know, in a sense, or sorry, those were $1.25. $2.57 total for that roll. So I've gotten a lot of decay out of that. And if you look at those other ones, those 215s, those were 41 cents when I rolled them. I had to pay 41 cents to get out of those and collected $2.98 for a total credit of 257. Now, if we look back at where those are now, you know, those 215s are trading, you know, 10 cents. So, you know, I would have only collected another 30 cents. But if we look at this, you know, I was able to collect a total of $1, little over $1, right? Because I collected a total of $2.57 for that roll. So $1. So that's why it's really important to make sure you make that roll, right? Because that has helped me tremendously. Some people might say, oh, you shouldn't have rolled them because now it's coming back down. You collect. No, listen, we're staying in the game by being mechanical with this, and that's what I'm looking to do. And if it comes down right around 250 with only, what, 21 days to go, you know, on next week, that would be great. So that's how we defend the strangle, is rolling to 30 delta. But remember, the probability of, if it goes down and hits our puts, you know, a different case than what we're showing here. This went up and hit the calls, but if it goes down and hits those puts, just keep in mind that make sure when it goes to the puts, I would say, is that it goes to your break even before you make that roll. On the calls, like I said, I got in this, I got a little aggressive with it because of that move, which you can't always predict. You know, sometimes I'd rather be lucky than good, and in this case I was lucky because I rolled aggressively. I saw I could get a big credit. You could see the volatility never even came off. It actually had started coming off and then came back up. So I was able to collect a nice credit for that roll at that time. So on this one, I bent that rule. But you know, if the gut, you know, I talk about this also in these webinars. If your gut is telling you to do something, go with your gut. Don't talk yourself out of it. Make that move, because your brain is processing so many things that you can't really pull to top of mind, that you will, and I can't remember, I'm trying to think of the ego, id, and superego, which one is making those determining factors there. But at the end of the day, I just had a bad feeling about this, and that's why I ended up rolling. It just looked like it was getting too aggressive to the upside, so I needed to be a little more aggressive in this instance. All right, so I see a bunch of people are asking some questions, so I'm going to try and go back in time and try and check it. What do you do with the tested side? Well, with the tested side, we're leaving that unless we roll that out in time. So the next step would be if we're, you know, I'm going to need to make this decision rather soon, within, you know, I like to say 10, 15 days to expiration is when we're going to look to roll that out in time. And if I wanted to stay with this trade, and then you just roll to those same strikes only if you can get a credit. That would be the next step on the cycle of this strategy, but that is only when you are still under the market neutral assumption that it's going to come back down within your area. Okay. What happens if it reverses? Trevor's saying. Are you saying what happens if it reverses and comes back down and tests my puts? Well, there's a 60% probability of it coming down and testing those puts now, because remember, I rolled up from a very shallow delta to a 30 delta. So there's only a 30% probability of those 245 puts. These 245 puts, let me pull up the platform here. There's only about a 30% probability of those 245 puts being in the money at expiration when I made that roll, okay? So we can go to the delta. There's only a 30% probability of that. You know, it's gone down to 20 already, but that's right now. But when I set this up, I'm looking at the deltas that I did it at, and that was a 30 delta. So the probability of a touch, it coming down and testing that, is 60%. It's 2 times the delta. And that's the floor trader hack I want you guys to take away from, to know, you know, I'd rather have you think the probabilities are higher than what they actually are, to kind of, you know, have your expectations in line. But what I said with this was, after the rally, like we saw with the Boeing here, after this rally, probability, after you get these kind of spikes, probability of that coming down and touching my puts are only about 38% from what I came up with, and expired below it only 15% of the time, whereas the expected expiration below that 30 delta would be about 30%. So it's almost half of what the probabilities after a big rally like this, after you get those spikes and get tested on those calls. It's better to roll the puts again than it is the calls, because the calls have a tendency to, when you see it come off, I notice that it has a tendency to pop back up. So make sure if it goes down and tests your puts, that it's actually testing your break even, unlike this, where I got a little aggressive. Anytime you see something like that, like after you put that trade on, might be a good time to get a little bit more aggressive, maybe before it tests your break even, if your thought process changed. And that's what my thought process changed. Here's basically also some of the you know, trader in me, as I started seeing this happening, and I was like, I went out and I started looking what's going on. Basically, news started coming out that the government was going to put a 220% tariff, I believe, on Bombardier. And basically that was going to help Boeing, right? Well, tariffs are never good, by the way, but that caused a little euphoria in the market. Well, basically right in here somewhere, Great Britain came out and said, well, Boeing, you know, it may be all good for you, but we're really good friends with Ireland, and that's where most of these wings are being built, and you're putting a tariff on them, and that could jeopardize your relationship with us on building aircraft for us. So, you know, that's kind of where all of a sudden, well, it's maybe not such a great thing after all. But so that's also allowed me to stay in this trade. So those are some outside things that I saw as well to get me a little bit nervous and more aggressive with defending this strategy, not exactly in line with what I say when you're tested on your break even and things of that nature. Does that make sense? I know that was a long-winded answer for you. Also, what else was it? Oh, Dan, did I say the wrong break even to the downside on those 215s? May have. Anyway, does the roll cost you anything? Well, it's going to cost you commissions for that roll. You know, it's basically putting on another trade in a sense. So yes, it is going to cost you commissions, and I don't usually talk about commissions because everybody's commission structure is different. But don't do it if you have to pay a debit. If you have to pay a debit to roll, do not do it, because you're already somewhat increasing your risk by rolling that out, and not really increasing your risk necessarily, but you're taking on risk by rolling that out in time. But if you're having to pay a debit, you're lowering your break evens, which is really increasing your risk. So don't ever roll it for it if you have to pay a debit to roll it. Just get out of it. And only do it for a credit by rolling that out. But you're rolling out for the same strikes if you roll out in time to the next monthly usually. Now I know we have weeklies in a lot of these, but it's not going to give you enough bang for your buck. Because remember, when I talk about theta decay and stuff like that, the big theta decay starts happening about 35 days to expiration. So if we're in this trade right around 10-15 days, usually the next month is going to have right around 35 days. So you could say if I took off 5-6 days from this, take off 6 days from this, we're right in that 45 to 35 days to expiration for that big theta decay out of these premiums. So that's why you don't try and ride this out to the end, because you're not going to get anything for a roll if you roll it too late. Okay. All right. Does that make sense? Okay. The duration of the roll, what duration? 30, 60, 90 additional days. So we're going to roll to the next full monthly. So 45 to 35 days. I think I answered that while we were just talking. And earnings is 10.25. Would you roll past earnings or just get out of it before earnings? Great question, Brent. Yes, I would more than likely get out of this strategy, because especially if I've had to defend it, I've had to roll it, it's going to be a pretty tight strangle. So I would probably get out of that. Another reason why is because if I roll into the month that has that earnings in it, volatility is going to start increasing on me, no matter, especially if I put it on 35 days and the earnings is, let's say, at the end of the month. Volatility is going to start ratcheting up the closer we get to that earnings. And anytime volatility increases, when we have a credit spread on or a credit strategy on, that volatility is going to increase the premiums, which is going to hurt us. It's not going to allow theta to come out of it necessarily, in a sense. For the best analogy, if you will, volatility has a tendency to hold on to theta and doesn't let it go until volatility comes out. But as those premiums get pumped up, yes, that will hurt us. So I would suggest getting out of it. Great. I'm glad you brought that up. That was something I had meant to mention, not to roll into an earnings. So try and avoid that if at all possible. I wouldn't even skip, Brent, past, I wouldn't, like if the earnings landed here in November, I would not go out to like the December contract, because I'm still beholden to that binary event that could cause it to move outside of my wings dramatically, as a matter of fact. So I'd just stay away from it. Okay. It's French, Rick. I cannot read French, and I'm probably glad at this point. All right, so that's about it. I mean, no, this was a rather quick webinar, but do you guys have any other questions about how to stay on this strategy when we're doing this? Because it's really about playing the probabilities, and you guys know, especially if you're watching my daily market commentaries, I try and beat that drum to death. One of the things that I learned on the floor when I first started trading, and some of you guys that have been in a lot of my webinars know that one of the first things I learned from one of the biggest traders on the floor of the Chicago Board of Trade, and he was in our pit, as a matter of fact, he was asking me how I was doing trading. I said to him, I'm up this much money, he just like cut me off right there. And he looked at me and goes, when you stop thinking about it as money, that's when you know you've made it over that hump. That's when you know you can be a long-term trader. And that really struck home with me. Is like, you got to play the probabilities, and that's what it's about. It's not about the money. It's not about making money or losing money. You're going to lose money, but you have to stay with the probabilities, because ultimately you get away from that mindset of money, 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 and I've got to make money. Well, that struck a chord with me, because I mentioned I had a psychology minor going through college, and before I switched it over to finance, and it really told me a lot about the psychology. You know, you got to separate yourself from that emotional attachment to money, which we all have, and it's very difficult. So one of the easiest way to do that is to start thinking about these things as probabilities. Yeah, this is the offer, and the link here, I forgot to throw it in there. Let me just throw the link in there. Somebody's asking about the link right now. So it's going to be in the chat window. So let me just get this out there real quick. All right. I think I got it in there. Colombian coffee, I don't know where that came from. Sorry, the Colombian coffee thing is, I don't know where that came from, but the links I'm putting in there right now are for the right thing. All right, so anyway, sorry about that in the chat window. Check the bottom link. So I was obviously thinking coffee today, but you know, it's all about the probabilities, you guys, and start trading and thinking about probabilities. Write it down. Don't think about like the money. Think about, you know, 50% of max profit is this, the probabilities of that are this. I mean, you guys are going to be a better trader if you start thinking about it as probabilities. I mean, when you guys all agree that money has this psychological thing in our brains that creates emotion, and those emotions we have to separate ourselves from. And the only way to really do that is to play the probabilities. So, I mean, you guys need to be trading with this knowledge, especially during earnings. I go through all the ways to trade earnings. We were kind of mentioning that before. I talked about how to trade the strangle around earnings. I love trading the straddle around, or sorry, the strangle around earnings. That's one of my favorite strategies for earnings. But I also do short calls, short puts, spreads, short puts, all of that stuff. And I go through each and every one of those and how to set it up for earnings specific, which are slightly different than what I would say to set this up in a non-binary event situation. So this is specifically for binary events. And those of you who aren't familiar with binary events, binary event is a known thing that will affect the underlying in a sense. Fed fund futures, the binary event is FOMC meetings. So, so they all have their own binary event. You know, WASD was the big binary event for the corn and beans and stuff. So, anyway, this is the link also right here. You can click on it. Everything's going to be a dead link besides that one that is in the chat. That if you're watching this on the rerun when we send this out, then that's the link there. So bottom line, you guys, the best way to become a better trader is to constantly learn, which is obviously what you guys have done. You clearly made that decision by doing this. But what I really want to get around is, you know, just knowing how to create an option strategy or anything like that is not going to be necessarily enough to create consistent winners. And, you know, this is another step in that process of learning how to become a more consistent trader. Being mechanical, knowing when to roll, when to be defensive in these type of strategies. So, and just trading technicals isn't going to be enough. I mean, obviously, I was looking at the technicals on this Boeing trade and didn't necessarily work out, but I traded with the probabilities, and it's looking like those probabilities are starting to turn in my favor after being mechanical about this. So, being a technical trader and just knowing how to create a strategy is not going to be enough to create consistent winners. And what I talk about is setting these strategies up with high probability of success and how to set those up with high probability of success. So, you know, at the end of the day, the only way to get ahead in this game is to trade those high probabilities and become more mechanical. Anyone can teach you how to build those strategies, like I said. And I teach these ways to play high probability strategies, all right? And when the strategies go against us, like in this Boeing trade, you know, how and when to stay mechanical, increase your probabilities even further in our favor, and ultimately is going to create alpha in your portfolio. So when you're using the right tools and right situation, you guys, you're going to be more productive, state of mind, put on more strategies, which creates more opportunities and ultimately builds confidence. You know, when you're trading with this, you might go out there and do a strangle the very first time and it goes against you. Well, in the past, hopefully you had been, or not, I shouldn't say hopefully, in the past you may have been like, you know what, the heck with this strategy. I'm going to be more like this. Well, now that you know the probabilities, you'll be more likely to say, hey, you know what? The probabilities went against me here. So now the next, 8, 9 times, the probabilities are in my favor. So, I'm going to have that success further down the road. All right. So we're offering this trial for you guys today, and I suggest you guys sign up for it. I mean, for $36 earnings trades, I mean, that's where I make the bulk of my trades. As a matter of fact, if you watch the daily market commentaries, you guys know I've been saying, hey, I'm going to hold off putting on a couple of trades right now because we're getting ready to head into the meat of earnings season. I want to hold off on some margin here so that I can get ready for these earnings trades, because they're the most fun. Volatility is at its highest and it's going to come out. I mean, what better way to trade, right? All right, so take advantage of that. If you learned anything from me at all today, you guys should be trading with this knowledge. So what do you say? Go ahead and click on that link. Like I said, there's 2 of them in the chat window, or actually 3 now. I just threw another one in there to kind of get rid of my coffee comment. I don't know where that came from, but anyway, take advantage of that. I see there's a couple more questions. One other thing real quick. If you have any questions, you can call us 310-598-6677. trading@protraderstrategies.com is also our email, and it's a great deal. There's several videos in and around these earnings trades that you guys can, several hours. I mean, I think there's probably like 8 hours or so of video for these things. That's off the top of my head. But anyway, I want to thank you guys for attending here. In later webinars, we're going to be drilling down on options, components, how to trade, when and where I find them appropriate. If you have any questions on anything, you can reach out to us at protraderstrategies.com or call us at 310-598-6677. Again, here's that link that is dead. I can't even click on it. But you can pause the video and punch that into your URL. All right, so that's about it. If you can't take that, take it easy. And I'll go back to some of your guys' questions real quick, so because I saw some people were blowing it up while I was talking there. What trades are you in now? I'm in Boeing, MasterCard, XLV, XLK. This is off the top of my head. What are some, of course, the ones that are sticking in my head right now are the ones that are thorns in my side. That's because I talk about those all day long in those daily market commentaries. I can't think of off the top of my head right now. You caught me, but I have quite a few trades in there. Could you turn the tested side into a spread? You could and go in there and buy it, but you're going to be paying a lot for that defined risk part of it, and you're going to be lowering your break even by doing that. And knowing the probabilities that I've talked about, I would not do that. All right. Love it, Rick. Thank you. Hope you have a great weekend, buddy. All right. So do your video training programs, go over defending, given trades, when and where to get out, falling positions. Yes, I do. And especially my daily market commentaries. Like my daily market commentaries, like I tell you exactly what I'm doing, when and where I'm doing them. So, just like with this Boeing trade, I said, hey, I'm rolling this strategy up. And there was something else I talked about today was with, John Deere. John Deere, I rolled up some, or actually, I have a pairs trade on with John Deere. I'm long and I'm short Caterpillar, and I rolled my short calls in Caterpillar, or sorry, I rolled my short puts out in time in Caterpillar to collect a little bit more credit, because that Caterpillar trade just has continued to go sideways. I thought Caterpillar was going to come off, Deere was going to rally, Deere rallied, and so I just collected a little bit more credit and how to defend that, increase my probabilities with that. So stuff like that, Crystal, I talk about in the daily market commentaries a lot, but I do talk about that in these webinars. Very interesting and useful presentation today. Thank you. Thank you, Andrew. Appreciate the kind words. You need more coffee. I do. Trevor says I need more coffee, and I do probably. I can't see all what you wrote there, Stan. Hold on, I have to stretch it out. Oh, have a great weekend. Okay, thanks, Stan. You have a great weekend too. Appreciate that teaching us. Thanks, Trevor. Murray, thank you. Appreciate the kind words. You guys all have a great weekend. And like I said, I hope you guys learned something from this. I mean, I don't know of anybody else that's that teaches the way I do. So I hope you guys can learn something from each and every one of these, even if it's a little nugget takeaway, all right? So have a great weekend, you guys. Thanks, Murray. I appreciate it. Good night.